obviously been presented a lot of this material, but those of you who've never been through this, you should see, wow, this sentiment stuff is really pretty cool, right? All right, so here's the implications of the triple top and triple bottom. It's a clear signal that the trend has run out of momentum. The triple top reveals a lot of selling pressure is building up. The triple bottom reveals that there's a lot of buying pressure building up from the bottom. And obviously, when it breaks out, the momentum comes flooding in with it. You're going to enter the trade on the breakout of the thing that we call the neckline. That's those little swing points there. Increased volume on the break is a very good, strong indication. Doesn't have to happen, but it's a strong indication. And ideally, you will have the extra volume supporting that breakout there. Okay, now let's go one more step further so you can see how this is adding up. We got a V, then we got the double top and bottom, then we got the triple top and bottom. What happens when we go beyond triple? Well, we really get into a multi-top and bottom, and what this is it's basically the same as the double and the triple, but you're going to qualify it as anything that has more than 4 peaks or 4 valleys. Now, the interesting thing about these multi-tops and the multi-bottoms is in the end, they kind of look more like a channel or a trading range than they do a top. Functionally, they're actually behaving the same. So it really doesn't matter what you call it. In fact, a lot of times I'll see them and we'll trade them and we'll treat them just like it's a channel, which I'm going to teach you the channeling pattern in a moment. But most of the time we'll treat it like it's a channel. But, if you identify it and you say, well, that's a multi-top, then, you're going to be correct as well. Let me just skip straight over here. Here's a really good example of one. Look how you can just draw, in this case, 4 peaks straight across the top here. And, it's just like any other double or triple top. It's just got lots of them. And so we traded up here, made a high, made another high, similar vicinity. And so this resistance is really building up there. And then this support level down here, and that becomes the breaking points here. And you're going to also notice that when this broke out, take a look here, there was a couple different levels. There's the 2 support levels that were really being measured on this trade. But when it broke out, ultimately, what happened? It came right back up, tested that old support as a new resistance. When it could prove that, yep, that's going to hold, the selling pressure came in. Now watch what happened here. It came right back up. Which one did it test this time? It was the other old support as a new resistance. This is such a predictable trading behavior. I'm telling you what, I can look at chart after chart after chart, reversal pattern after reversal pattern, and show you over and over how these trades, they break down or they break up, they turn right around, test that previous area as support or resistance. It's just incredible. The predictability of how often these things happen. Okay, so there you have it. That would be what I call a multi-top. Turn it upside down, you pretty much have a multi-bottom. Here's an example of multi-bottom. This one's got 4. The truth is you probably could have come way back here and added 1 more in here. It was all one giant slowdown of the trading behavior. And that's really the message. And hopefully that's the message that you get in this class tonight. Yes, we have names for our chart patterns. Yes, individual chart patterns mean certain things. But on a grander scale, they all are telling us the same thing. And that same thing that I really want you to get, and this is the real lesson, is after the selling pressure has happened, we're going to have a buildup of the support down here. And that buildup of support, whether it be one day or whether it be a double bottom or whether it be a triple bottom or whether it be a multi-bottom, the buildup of that support is the same. And it is literally the accumulation period that Charles Dow talked about in the Dow theory. That's when the traders are taking on their new positions. And once the sentiment makes its shift, that's when the bullishness comes back in and the whole cycle will take off. And you can see here, I left a couple of the candles on from the following trend. You can see what happened. We got the trend reversal in here, and then it just gapped up and it took off. And this is often, people say, well, how do I catch a gap? This is often how it will happen. You'll end up with a bottoming formation such as this one right here. You'll get in on the entry, which is the breakout of the neckline there. You'll get in there just thinking, well, this is going to be a good trend. And you don't necessarily know there's going to be a big gap. And then suddenly what happens, it gaps up $30 in one day. And you say, oh, thank God, that was a good day for me. And you take your profits and you laugh all the way to the bank because you knew it was coming just simply because you saw the bottom. You didn't know it was going to be a gap, but you knew it was going to be a good move, and that's all that really mattered. All right. Now let's look at a variation of the triple tops, and this is what we call the head and shoulders pattern. And the head and shoulders, again, it's a variation of the triple top. You basically have a left shoulder, a head, and a right shoulder. The left shoulder is going to make a new resistance. This is a bullish reversal, or I guess I should say a bearish reversal. It comes in a bullish trend, reversing into bearish. So it's a topping pattern. You'll have the left shoulder creates a new high, pulls back, moves higher to make a higher high. So you see that higher high in through here. The head retraces into the same vicinity as the original one, and then the following bounce is a lower high. And so there's your left shoulder, your head, and your right shoulder. You can see how that happens there. This is where the name and the term neckline comes from. It's the neck of the head and shoulder. Okay? When the pattern breaks that, that's going to be your entry into the bearish trade. So, again, you got your left shoulder, you got your head, your right shoulder. This is the neckline right here. That's going to be your entry into the bearish trade. Just like with most of our double tops and triple tops, a lot of times it will come back and it will test that before it will continue. Let's look at some real ones here. I always like the real ones a little bit better. This one over on the left is a typical head and shoulders pattern. Notice the formation over here. The first initial form of the peak actually was very, very high, pulled back, created the bottom here, and then we made a head that came up in through here. We pulled back essentially into the same vicinity. That created the neckline. Okay. Following rally failed, so we ended up with a higher highs, lower highs, and then once we broke through the neckline, there's your first lower low. That is your trend reversal signal. That would have been your bearish entry. It would have been about $75 a share, would have been a typical place where you would have gone bearish. This is a very it's as textbook of a head and shoulders as you can get. Even though it doesn't look, just perfect, it's a textbook head and shoulders. Okay? So there you have it. There's your head and shoulders pattern. Now, the one on the right, I ran across this pattern when I was looking for patterns, and I wanted to include it. This is what I would refer to as a complex head and shoulders. And yes, there's an actual classification of complex head and shoulders. I don't usually talk about them because they're not really that common, but I did run across this, and I want to share it with you. In this case, we've got several peaks. We've got two left shoulders, we've got the head, and then we've got three right shoulders. And so this is a very unique situation where we actually had multiple right shoulders and multiple left shoulders, and it turned out we had 5 shoulders in all here, 2 on the left and 1 on the right, but it was still a head and shoulders pattern. And the interesting thing is the neckline does come through here, and it really does set us up for the bearish entry to go into the bearish trade. Now, you're going to notice a big time difference here. This particular pattern took 1, 2, 3, 4, 5, 6 months to play out. Is that reality? In the case of a complex head and shoulders, yeah, that's totally fine. You would not have seen a head and shoulders do that. But if it's a complex head and shoulders, it takes a lot of time for each of these peaks and valleys to form. Look at the head and shoulders over here on the left. This is 1, 2, 3.5, maybe 4 months that it took this one to form. That's very typical of a head and shoulders. So a head and shoulders might be anywhere from 6 to 8 weeks minimum up to 3, maybe 4 months. Whereas this complex head and shoulders, it took the majority of the year. It took 6 months, but there was a lot of transitioning. And you can really see here that even though this was a topping pattern, you can see that this was more than anything a consolidation. And so when we talk about consolidation patterns here in about 5 minutes, you're going to learn what a consolidation is, and you're going to say, wow, that looks a lot like a channel. You could actually draw some lines here and say it looks like a channel. And in truth, you probably would have traded it a lot like a channel at the time, because you could have jumped in at the top and jumped back out at the bottom, vice versa here. And, you would have just had this one big head that came into play here. But what I want you to be able to do is I want you to be able to step back from the trade as you look at it and say, wow, I thought it was a channel, but in hindsight, that's a massive complex head and shoulders. This is a big reversal. And so, of course, it did turn into a massive reversal. You can see on the right here, Massive, massive reversal, breaking down at 100 all the way down to $80 in about 4 days. That's a huge sell-off. All right, so there's your Head and Shoulders. Now, the Head and Shoulders has the following sentiment implications. First of all, the trend was progressing nicely. It looked strong, and suddenly the bulls can't match their previous highs. That's the story of the Head and Shoulders. See, you had the nice progressive bullish move. Everything was making higher highs. Everybody thought it was bullish. It came back down, and that third peak, it's like it went wah, 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 wah. We can't make the higher high. And that failed rally that could not even make the higher high, that is the signal that says, no, this trend's reversing. Once you break that neckline, that's a solid suggestion that trend has reversed, and most likely you can actually go with the trade at that point. Now, if you turn this around, that was a bearish reversal. If you turn this around, we have what we call the inverse or the inverted, or some people would call it an upside down Head and Shoulders. The idea here is that it's the Head and Shoulders, but it's upside down. And so you can see that formation there. Stock's going to hit a new low. It's going to bounce. It's going to continue downward, make a new lower low. It's going to try it again, but it's going to make a higher low. And then we have a breakout of the neckline here. It'll be a bullish reversal in this particular case. So you can see the low, the lower low, then it's a higher low, and then we've got the breakout. Now, if you named this like a Head and Shoulders, you'd have the left shoulder, you have the upside down head, and you have the right shoulder, and that becomes the inverted Head and Shoulders. So again, it's like a triple bottom, but that middle peak in this case is going to be lower, making an exceptionally lower move there. I've got a couple of inverse Head and Shoulders to point out to you here. This one on the left is pretty typical. You can see that one over here. Traded down to about $42, $43 a share, bounced, tried it again, and then your neckline starts to get formed solidly across here, and that becomes your entry point. Now, you notice that my neckline is going slightly downhill. That is not atypical. This does happen quite frequently where you'll have a neckline that's just a little bit angled, and that's just fine. That's still going to be the neckline. You're going to connect these peaks right here. That will create your neckline. Okay? Then you can see what happened here on the breakout. Look at the breakout here. We broke out, and we came right back down to test that neckline area, and then we continued in the bullish trend, and we had the full-on reversal. Now, this one over here on the right, this is actually a currency. You notice the awkward pricings. That's because this was on the euro. And you're going to notice that this one was slightly irregular. Not too irregular, but it was slightly irregular because we had two left shoulders. We had the head, and then we had the right shoulder. But it's still the same basic formation. We're going to take this neckline. We'll form it right through here. And there you have it. That's going to be the breakout. This was a massive move for the currency. You can see the proportional move. And you can see how big it moved there. So that's an inverted Head and Shoulders on the euro right in through there. Okay? Makes sense? Now, here's the implications for the inverse Head and Shoulders. Trend was progressing, looking strong. Suddenly the bears cannot match their previous lows. When we get the break of the neckline, it's a solid suggestion that the trend has reversed into a bullish trade. Okay? Now, let's take a look at this next pattern, what I call a line pattern, or some people call it a flat bottom. I prefer the line terminology. Because I've seen these at tops and I've seen them at the bottoms. Thomas Bulkowski, who's probably done the most research on the subject of chart patterns and their frequency and whatnot, he actually is not a huge fan of this pattern. I think to his detriment personally, but probably shouldn't say that. He's not a huge fan of it. Feels like he can't find enough of them. I actually have found plenty of examples of the line patterns, and I have found that they're excellent trading opportunities. So that's the reason I include them here in this particular class. So the line pattern is going to happen after a decent trend. It could go bullish or bearish. The implication of a flat bottom obviously suggests that it was a bearish trade that created a flat bottom. But again, I've seen this going the other way just as much. The stock basically stops moving completely. And you may not notice it from this because you might think, well, that's a pretty good little trading range. It's not. I mean, this is literally just like we stopped moving, just stopped. This is going to last at least 2 weeks. Usually I'll see them last for 3 or 4 or 5, 6 weeks. It can last a long time. And then what's interesting is this line pattern precedes usually what becomes a huge move. And very often, I mean, it's a massive move that could be like a life-changing trend. That's why I like them. when I find them, it's like, hey, there's an opportunity. This usually happens as a bottom, but again, it can happen as a topping pattern. Let me go straight to my example. There you have it. You see how tight that range is there? You see how tight that trading range is? It's so small that you cannot call it a pattern of any other sort other than a line. I mean, it's just like you pray and hope that this never happens to your heart monitor, because if it does, you're in trouble, right? And so as you see that through here, the line just stopped. In this case, it went for about 2 months. And then when it breaks out, it'll be huge. Now, here's the interesting thing. This one has not broken. I took this screenshot today. And so if you watch this video later, it will be late. But I'm just going to tell you right now, this is ticker symbol SUN. That is Sunoco. And this is a present chart pattern right now, today, on Sunoco. I expect this will break in the next 2 or 3 weeks, and it will probably be a huge break. For those of you who've been through my classes before, you also know that that's going to be a Bollinger Band squeeze. So hint, hint, go take a look at that. Go take a look at it and you'll find out that it's really there. All right, those are my reversal patterns. More often than not, these turn into reversals. They can be continuations. Honestly, the line pattern is kind of, I don't know that I really solidly classify it as a reversal. Technically, I have, but it really can go either direction there, and I don't feel strongly that it has to be a reversal. But I do feel strongly that it's a pattern of behavior, shows that the momentum has stopped, and when it breaks out, either bullish or bearish, you can trade it. Just so you know, how do you set your entries on this? It's very simple. Bull, bear, and you don't care. Set a bull on top, set a bear on the bottom, and you don't care which way it goes. You just go with it, whichever way it goes. Okay? All right. There you have it. So now, those are your reversal patterns. I want to get you into your consolidation patterns before we call it an evening here. Consolidation patterns are essentially, functionally standpoint, they do the same thing as reversal in the sense that they are shaking out or consolidating the buyers and the sellers. So we've got a shakeout of the sentiment. The big difference with a consolidation, when you see these patterns that I'm going to teach you tonight, they go either direction. You see, the patterns I just taught you, technically they are consolidating, but they almost always turn into reversal patterns. And so that's why they're classified as reversals. These particular patterns I'm going to show you, they can go either way. It's 50-50. And so we can really see them in a bullish trend continuing, or we can see them in a bullish trend reversing, or in a bearish trend continuing, or in a bearish trend reversing. Of course, you're not going to know completely what's happening, whether it's reversing or whether it's continuing, until after it's happened. So we have to learn how to enter based on the breakout of the pattern. As a broad function, a consolidation pattern is when a stock is not moving. It's not moving either higher or lower. It's trading in some sort of a consolidation pattern, revealing a shakeout or a consolidation of the sentiment. Consolidation patterns are a consolidation of the buyer and seller, as I've just mentioned to you. It's going to reflect a roughly, quote, agreed upon price for the stock for that time being. Now, when I say it's agreed upon, it may be a $10 trading range, but there's a big difference in a $10 trading range and a $50 swing. So for that moment, we've got a pretty much agreed upon price for the stock. Usually it doesn't fluctuate more than 5, maybe 8 or 10% of the price of the stock. I mean, I've seen some that really fluctuate more, but normally, kind of on average, it's going to be about a 5, maybe to 8% fluctuation of the stock value. It can either continue the trend or it can reverse the trend. It almost always functions as an accumulation or distribution period. That is the important thing. Almost always functions as a accumulation or distribution. So you guys remember the Dow theory discussion we had when I showed you that accumulation distribution cycle? These are the patterns you're looking for. There are 2 classifications of consolidation patterns. Number 1 are your channels. That's your trading range channel. Number 2 is your triangle. These are larger patterns, meaning they're going to last for at least a couple of months, probably 3 to 4, 6 months, 8 months. I mean, you can see these things lasting a long time. Currently, at the time of teaching this class right now, CSX, ticker symbol CSX, is, it's been in a consolidation like this for months. I mean, I think we're going on 8 or 10 months. It's just going sideways, just going nowhere. It's a clear consolidation of the buyers and the sellers. Okay, so let's take a look here. The channel is probably the most popular kind of consolidation. Most people have learned how to identify these at this point in my class. It's a stock. It's moving sideways between support and resistance. Sometimes we refer to them as rectangles. Usually I reserve the rectangle terminology for a shorter term. But yeah, I don't care. I'm not that picky about it. So sometimes we call them rectangles. It always qualifies as a trading range, meaning the stock is tends to be trading in about I put here 3 to 10%. I put 5% on that other slide, kind of as a general target. That's not scientific. Don't hold me to that. It can last for months, and basically what's happened is the stock is trading up into resistance, pulls back into support, back up into resistance, back down to support, and just does it over and over again. Here's a good example of one right here. Notice you've got two levels of support and resistance, so we would call these a zone, a resistance zone up here, and we would call this a support zone down here. Now, it is a zone, but you notice on the bottom one, we only hit it once. Top one, we had a couple hits on it, and it hit it over here on the far right side. But anyway, you look at it, notice the trading behavior, just running up into resistance, pulling back, running up into resistance, pulling back. And this is big. This isn't an afternoon. This is 1, 2, 3, 4, 5, 6, 7 months worth of time on there. And this can break either direction. It can break bullish. It can break bearish. It can go either direction. Now, one way that people like to trade this is a lot of people like to try to buy down here and sell up here, okay? And that is okay. It's really not my favorite. I mean, if you're trading stock, that's the way you would trade it. You would buy at the bottom, sell at the top. But what I would rather see you do is later when you learn about options, I'd rather see you sell options during a time period like this. As you're trading up here and start to roll back over, sell a call. Okay, and then as you come down into the bottom here and you start to go back up, sell a put. And you're going to find that selling calls and puts, and when I say selling, I'm actually talking sell to open. So sell a covered call or a naked put. Sell them as the stock's going in the opposite direction. The time value of those options really helps you when you do that. So that's a little bit of advanced strategy. You can just make a note to come back and mention that to yourself once you get into the strategies in level 3. But that's really ultimately the way I'd rather see this traded. And then the best way to trade it for the trend is trade the breakout. Okay, so whenever we come up here to the top, people say, well, should I do a bull put spread? Or they throw out some of these option strategies, and I say, well, I don't know. Only if it reverses, and the trade would be a bear call spread. It would be a selling of a call. Only if it reverses. In fact, last night in Power Trader, I did a trade setup like this, and I showed you guys. I said, well, if it goes down here, then you can sell some calls up above it. Because obviously the trade's going in the opposite direction. You want the value of those calls to go down. So if you owned the stock, let's say that you had a stock that was doing this. By the way, this it's not current, but this was ExxonMobil right here. So you can go back and look at it. And if you were trading ExxonMobil through this time period and you owned the stock, well, you might be frustrated that the stock is just trending from $54 to $62 and back down. But what if you sell covered calls? See, that's an awesome way to bring money in on a stock you own. When a stock you own gets stuck in a consolidation like this, start selling the crap out of covered calls. And what that's going to do is it's going to bring money into your account. And you can do that with a weekly call. You can do it with monthly. You can bring in all this extra money. Maybe it's not massive amounts, but it's something. And oftentimes you can bring in 3, 4, 5% pretty rapidly, and you do it over the course of a year. You can definitely bring in possibly 10, 15, upwards of even 20% sometimes. Depends. I mean, all that's very depends on the stock, depends on the volatility, blah blah blah. Depends on how many you write, depends on how risky you take it. Are you at the money, how far out of the money? Lots of variations, but the bottom line is there is money to be made selling covered calls. Oftentimes it's very good money, even though the market's going nowhere. And so for those of you that own shares of stock, that would be a really good potential strategy to look at in this type of a trading situation. Okay, hopefully that was making sense to you. Now, let's just kind of sum this up for the trading channels. You can trade the inside of the range like I just showed you, but the best, most profitable setup is to trade on the breakout like I just showed you. Set your bullish and bearish entries on the outside of the range. So it's up here, it goes bull. Down here, breakout, goes bear. And until it goes one way or the other, you don't really care. You're just going to trade the inside there, and hopefully, in my perfect world, you'd be writing some options there. Channels are the worst type of a pattern for having what we call a false break or a whipsaw. Meaning, you'll see a channel, it breaks out like it's going to go bullish, and then it turns right back into the channel. Or it breaks out like it's going to go bearish, and it comes right back into the channel. They're notorious for that. Because of that, some people don't like to trade them. I just say, be prepared, know it can happen, set your stop. And if it happens, then you just go back into the channeling formation, you go back into the pattern, and you wait for a bigger break. The break of the channel, here's the good news about it. The break of the channel is almost always the start of a new long-term trend, very much worth trading. Okay, once you see the channel break, it's worth looking at that trend because odds are it's going to be a substantial move. People always say you can only make 5 or 10% on a stock, and if you trade it extremely conservative, that's true. But if you watch for breaks of some of these big patterns like a channel, those are the times when the stock doubles, and it does it in 5 or 6 months. And so, those are the kind of patterns that you're looking for to get those really big trending moves. Okay? Now, let's come on over here and talk about triangles. Triangles are very similar to channels, often a misunderstood pattern. Misunderstood because people always try to make wedges triangles, and they try to make pennants triangles. They're different. We're going to look at pennants in the next class, but a triangle is a large pattern similar to a channel. All right. The difference is that its support and resistance are collapsing inside on top of themselves. So you've got an ascending bottom and a descending top. They're going to be similar in size, similar in time, similar in function to the channel. They're a consolidation. They're going to act as an accumulation or distribution period usually. But the difference here is, again, that support and resistance are collapsing inside themselves. It's very difficult to trade buying at support and selling at resistance on a triangle. Usually, the trading range, by the time you can even identify it, the trading range is too small. So it's not worth it. So it's very difficult to trade the inside. However, it's very easy to trade the outside. And so you can just set a little bracket trade up here. You can say, if I go bearish here or break down, I'll go bearish. If I break out, I'll go bullish up here on top. And again, just like the channel, this is usually the start of a new trend. And that makes it really cool. Another cool thing about triangles is their measured move, which means the way we say it is this first cycle of the triangle, whatever the size of that is, usually the breakout move will equal, that's going to be the minimum measurement. Okay, so the initial breakout move can be measured to the size of the first cycle is the way I worded it there. Either breaking out bullish or bearish, either direction there. All right, so that's kind of a cool thing about triangles. They're a measured move pattern. There's 3 types of triangles, and a fourth one I'm throwing in here called the inverse. But the 3 basic types are symmetrical, ascending, and descending triangles. Symmetrical, ascending, and descending. And then, of course, that variation is the inverse. The symmetrical triangle is going to be formed with lower highs and higher lows, just like this picture on the screen. Lower highs and higher lows. The support and resistance are collapsing in on each other. And this entire formation usually takes 2, maybe up to 3 or 4 or 5 months. Very rarely will it be less than 2 months. That's pretty typical. All right, just look at a couple of these here. Here's a good size symmetrical triangle. 1, 2, 3, and it broke out about halfway through the 4th month. Okay, so notice the move here. We moved from 195 down to about 175, so that's about a $20 move. And then this breakout, if you look at this breakout here, we broke out at 190, and the first peak came in here exactly $20 higher. Okay, so this first movement was a measurement of $20. First peak was $20 higher. I'm telling you, it's like clockwork. I mean, it's ridiculous. The breakout of a triangle is almost always and when I say almost always, we're talking about 90% of the time. It's crazy. That first breakout there can be measured to that first cycle. Okay, and it would, in this case, it broke bullish, but it could have broken bearish. It doesn't matter. The point is that you've got a triangle, you got consolidation of the momentum. Look at how similar that looks to a channel. The easiest way to remember the triangle is it looks like a channel, but the support and resistance are collapsing in on themselves. And if you can remember that, remember the breakout works a lot like a channel. It's usually the beginning of a new trend, and there you have it. There's your symmetrical triangle. Okay, now let's come over here to the ascending triangle. The ascending triangle is a little bit different. It's going to have matching highs, but it's going to have higher lows, just like this image portrays here. The support is rising while the resistance is staying the same. And again, this entire formation is going to take a couple of months. I personally feel, this is Jeremy's explanation, so we'll put this J-Dub's opinion. I personally feel this is more bullish than the other triangles. I can't prove that though, and I could sit here and argue with other technicians, and they would say, well, we're running into resistance, so it's more bearish. And I would say, well, I've got ascending support, so it's more bullish. Which one of us is right? I don't know. I can't tell you statistically 100%. I can just tell you that every time I see an ascending triangle, it seems that it breaks bullish. I really don't care which way it breaks. Take a couple of pictures here of some ascending triangles. I really don't care which way it breaks. You set the trade up the same way. You just sit here and say, well, if I go above this price point, then I'll go bullish. And if I go below this price point, well, more like over here. If I go below this price point, then I'll go bearish. And you really don't care which way it goes. But I personally feel like it's a little bit more bullish, again, because of that ascending support. Take a look here. You got that flat top coming in here right around $38 a share, and that ascending bottom. Again, it looks like a channel, but the support and resistance are collapsing in. Over here on the right side, you see a little bit less discipline at the beginning, and it finally got into this little triangle here, 140. 135 to 140 being that flat top resistance, and then that solid, 4 points of connection there on that ascending support, and that really became your trend line, and that created the bullish pressure on this particular trade. So you can see a couple of good examples of ascending triangles there. Now, just flip that whole concept, and you got your descending triangle. This is going to be formed with lower highs but matching lows. And so, we're running into support. Support stays the same, but the resistance is applying that downward pressure. Again, this formation takes a couple months. Again, J-Dub's opinion here, okay, whether it's the truth or not, I don't know. But in my opinion, this is more bearish. Again, I can argue this. I can argue it very intelligently with very good, well-intended technical analysts. And I can say, well, I've got, descending bearish pressure from that support or from that resistance. And they would say, well, you've got solid brick wall support from this support line coming in here. Eventually it's going to go bullish. And probably in their eyes, they see it go bullish more often. I personally feel like I see it go bearish more often. So I can't prove it to you, but that's what I feel is happening. And so I mentioned it to you. I might point out to you that a few minutes ago, we had a double bottom chart pattern, and I went back and I showed you a descending triangle. That one broke bearish in one of my earlier examples. But anyway, here's a descending triangle that I wanted to show you as an example. Again, look at how similar it looks to a channel, but the lines are collapsing upon themselves. And this particular one, descending triangle, broke bearish. And you can see the breakout here at the bottom. Okay, that's the descending triangle. Okay, now let's take a look at the inverted triangle. The inverted triangle is basically, some people call it a megaphone. It's just a backwards triangle. Instead of having collapsing support and resistance, you have expanding support and resistance. So you've got higher highs and lower lows. Support's falling while resistance is rising. And this can take many, many months to form. I mean, I've seen these things take a year. And what happens is it ends up looking like it's got insane volatility, because at the end of it, you're just trading a long, long way before you get to your next resistance. And it's hard to find the breakout. In this case, it's actually easier usually to trade the inside, jumping in here at the bottom, selling at resistance, jumping in at support, selling. It's easier to trade the inside because you actually have some boundaries. You never know when the inverted triangle is going to actually break out and turn into a new trend one way or the other. I will say that these also we call them broadening formations. Inverted triangle or broadening formation. I will say these tend to lead to a reversal, in my opinion. But again, I don't have the statistical data to back that up. But the several that I have found that I have looked at closely, they seem to be more reversal oriented. Here's this was actually currently forming. I forget now the stock, so I can't tell it to you. But this is a broadening formation on a bottom. And you can see again, it looks like a channel, but the highs are getting higher and the lows are getting slightly lower. Not a whole lot lower on this one, but a little bit lower here. And there's an expanding triangle. And this could go for a long time. And again, the reason it gets frustrating is you never know where the bottom is. You know, is this going to be bottom 31 this time? Sure. You know, this time it's going to be 37 as a top. Well, when do I break out and I go into a bullish trend? Or when do I break out and go to a bearish trend? You don't know. And so that's why the inverted triangle becomes a little frustrating, but it's a good formation and it's worth watching it. All of these formations, especially the latter ones, these consolidations, all of these formations are periods of accumulation and distribution. They all move into the cycles of the system of you buy, informed traders taking on new positions, public drives it to the next price, informed traders start to distribute. Now, sometimes accumulations can turn into distributions, and sometimes the cycle ends up looking something like this, where we got an accumulation period, runs up into a distribution period, and then it continues into another distribution period. And so these are very, very typical. You see a lot of these, and starts as distribution, turns into a reaccumulation. And then you get up here finally with a final distribution period. This is very typical. Every one of these cycles here are consolidation cycles, and they're going to take on the formation of a double top, excuse me, let me say it again. They're going to take on the formation of a channel, a triangle, or some variation of what we've just looked at here tonight. Usually it's the channel or the triangle, because those are the consolidation patterns. The double tops, triple tops, head and shoulders almost always turn into reversals, and you should approach those with the idea that they probably will turn into a reversal. Now, if you have a head and shoulders pattern, it turns into a continuation, whoop-de-doo, you trade it as such. But at that point, it probably is going to start to look more like a channel, and you'll say, oh, I thought it was going to be a head and shoulders, turned into a channel. So anyway, there's some subjectivity here to it, more art than science, but certainly we can get into the ballpark and say, in general, these are the principles. Okay, here's your action steps for the evening. Review your notes. We went through a lot of content tonight. For those of you who have been through the Legacy program, you realize that we just went through more tonight than we normally do in a chart patterns class. I essentially have put 1.5 classes into tonight's class so that I have room in the next class to add all the stuff that I'm wanting to put in there. So here's your action steps. Review your notes, take the quizzes online, and spend some time combing through various charts looking for patterns. And if you don't see them initially, that's okay. They will start to appear to you. It will take some practice. It will take looking at a lot of charts. And ultimately, it'll take working through the trader conditioning system to start to identify them. But that's your homework for the evening. And when we get back together for class number 4 here in level 2, I'm going to get into chart patterns part 2. So the next class, we'll start talking about what we call continuation patterns. And then we'll also get into gaps in the next class, which we're going to classify with continuation patterns and explain how those things all work out. All right, so there is your class this evening. Given the slow start, we actually ended right on time. We started about 5 minutes late, and we're ending just about 5 minutes late. Do you have any questions, comments, or opposing views before I close it out and call it an evening? Thank you for your kind comments saying that you enjoyed the evening, so appreciate that. Puri, the answer is no. The question was, is the Dow currently trading a triangle? And the answer is no, it's not. DG says that there's no pictures of the inverted triangle in the notes. Really? I'll have to check on that and see what happened to those pictures. I will have to see what's going on. All right, you're welcome for everybody saying thanks. I'm glad you really enjoyed the new class. So that's great. Thank you, Al. Thank you to all of you. This patterns are not absolute, says Alejandro. No, Alejandro, the patterns are not absolute. And frankly, that's a really good principle for all of technical analysis. As a technical trader, you need to recognize that nothing is absolute. Everything has got some subjectivity to it, and you want to learn the principle, but have the flexibility to let something else actually happen. Okay, so everything is very subjective for sure. Yes, tonight's class has been recorded, and it will be posted up on your posted up on your website probably in about 24 hours, give or take a little bit. Gene says, I love your classes, but it's like drinking from a fire hose. Well, Gene, a fire hose is great to drink from if you're very, very thirsty. How's that, Gene? See, I just don't want to under-deliver. I want to over-deliver. All right. All right. Well, you know, the other good thing is you got plenty of time to do your retakes here, and you got the videos so you can come back and watch them. I want to make sure you have the good teaching. For those of you who need to review it, you can review it. Those of you who want to spend some more time with it, you obviously have the resources to do that as well. All right. Kirk says, I want more clarification as to why you sell calls and puts in channels instead of normal buying and selling calls and puts. Kirk, hold that question till level 3. And when we get to level 3, I'm going to teach you more about calls and puts and options trading. And when we get there, it will make more sense to you. Okay? Paula, the answer is yes. Okay. I'm going to let my moderators wrap up a few questions in here that are a little bit more one-on-one questions. And you guys have an awesome evening tonight. Have a great day tomorrow. And I will look forward to seeing you guys on Wednesday's class when we start talking about chart patterns part 2. So good night to all of you, and happy trading.